to the real economy. And that's why the ESRB and in general, I think all authorities that are responsible of macroprudential policies, both competent authorities in the national and different countries and the ECB, should have the possibility of a toolkit, a broader toolkit, which could extend itself beyond the banking system to the non-banking system. It should also be possible to have greater visibility on these investors so that we have some more information on the interconnectedness of these non-banks with the rest of the system. In other words, like in general, the non-banking system, there is work to do here to protect ourselves from the materialization of sudden risks. On the specific question you asked me about lease legislation, I don't have an answer now. I do believe the SRB has not looked specifically to this issue, but if I find a different answer, I will make sure you get it in writing. We have to have I said before, extend the toolkit, macroprudential toolkit, to include the non-banking sector, but the same holds true for the insurance sector. So I completely agree with you about that. So we should extend this, and there are many things that we can do there. But there, in a sense, the task is in principle easier, because in the insurance sector, the perimeter of the entities that would be the target of this macroprudential policy is well defined. In the non-banking sector, it's harder to define.
This means you believe it's the ESRB that should deal with the macro-prudential risk of the insurance sector, because then they will claim that the representation in the board of the ESRB is not correct.
Well, the ESA are present in the board of the general board of the ESRB, but no, it should not be the ESRB necessarily to deal directly. The ESRB is not a decision-making institution. It has that. I mean, your design of the ESRB foresaw that the ESRB has so-called a soft power coming from information, communication, analysis, and recommendation. And that recommendation, by the way, revealed themselves to be a more effective instrument to engineer policy changes in different member states than one would have said at the beginning. So I don't think the SRB should have supervisory or macro-supervisory powers. This would not be consistent with the original design of the SRB. But the national competent authorities and the ECBs are the institutions that have this, or other, most notably the EIOPA is the natural institution that one would think about. Thank you.
Thank you. Ramon Tremosa.
Grazie, Presidente. Dear President Draghi, I have two questions. You have been talking about real estate. And my question is on NPLs, because many of NPLs come from bubbles created in the last expansionary business cycle 10 years ago. As you know, in this committee, we are discussing now the proposal for a regulation on NPLs. And as you know also, the Council has already agreed upon a general position, and it seems that this file will go through. The Council approach foresees a uniform calendar to be applied by financial entities in order to build up their backstops. So are you not afraid of an asymmetric shock in some member states because of the difficulties that some banks may face in building these backstops? And my second question is about a very specific debate we have had in the last weeks in this committee regarding the conception of failing or likely to fail. As you know about the Banco Popular case, there has been a long debate regarding the definition of failing or likely to fail, when a bank is likely to fail. The chair of the SRB said 1 month ago that this definition raised extremely difficult questions. But Madame Nouy, I asked her last week, and she told us that she found this definition clear enough. Do you believe this definition of failing or likely to fail in a bank is sufficiently clear? Thank you.
Thank you. Well, the second question, in a sense, it's easy to answer. Whatever Madame Nouy said is absolutely right. So she is the responsible one. If the SSM has worked with this definition, we are satisfied with that. On the other question is, can I ask you, what do you mean by backstops? You mean dismissal of NPLs?
The coverage of NPL.
Oh, okay.
Calendar provision.
Yeah. Now, first of all, let's start from a positive note, namely that there has been progress on NPLs reduction. They were 7.5% in early 2015, and they are 3.6% by the second quarter of 2018. So they've gone down for the aggregate, of course. One of the problems with the NPLs is that aggregate numbers often say very little. But that's what we have a down, generally speaking, we had a downward trend all over the banking system. In fact, all bank size classes have been going down. Now, the coverage ratio is 46% in the second quarter of 2018, and it was 46.5% in the first quarter. So we've improved, but the problem is not solved. Still, the coverage ratio is an issue. And now the SRB has worked intensively on this, and there is a very good paper. I believe it's published by the Advisory Scientific Committee on NPLs, discussing the conceptual foundations of a macroprudential approach to this. We continue working on that, and we continue our effort in trying to identify the vulnerabilities coming from that. Quite clear, they weigh on the banking system. They certainly, if the NPLs wouldn't be there, or if they were lower across the board, credit given by the banking system could be higher and more responsive to the general conditions of the economies. This is quite clear. Countries are trying to link, different countries are trying to link progress on the NPLs front to progress in moving forward with the banking union. In other words, one of the measures of risk reduction that is being negotiated by different countries relates to the NPLs. And relates to the NPLs with proposals indicate a quantitative target for NPLs to be reached if further steps on the banking union are to be agreed with. I think the effort is certainly worthwhile being supported. I'm not sure that identifying absolute quantitative targets across the board would actually be the best way to go. It's probably at least what the SSM has done is to identify expectations and have a pretty effective dialogue with banks across individual banks, asking them, and so the dialogue is both sides, of course, trying to identify expectations and targets bank by bank. The action is being pretty effective. That is but I mean, are the values that are being quoted in these negotiations unrealistic? Well, I don't think so. Thank you.
Thank you. And actually, yes, we are working on this calendar provisioning, and we will discuss the amendments very soon. Of course, I understand the question of Mr. Tremosa was about the risk that an automatic Pillar 1 calendar provisioning might end up to be procyclical in a moment of asymmetric shock. That's because, of course, some can be exactly bank-specific, can be, but and I think this is the reason why I think it's good that text of the Council and also what we are trying to do in the Parliament will be, let's say, significantly increasing the provisioning, but also not excessively strong, because that's, in my view, could indeed create problems in case of procyclicality. So that's why I think it needs to be effective but balance this Pillar 1 calendar provisioning, while the Pillar 2, that is bank-specific, can also be stronger or weaker depending also to the situation of the institution or also on the context. Mr. Langen.
Ja, vielen Dank nochmal.
Thank you very much. I just wanted to make a general comment first. I think it's remarkably sad, almost unacceptable indeed, that there are so few colleagues here for the monetary dialogue with the ECB president. I say that often because I think it's unprecedented. Since Duesenberg, I've always been here 2 or 3 times. Maybe I've missed it, but out of the many I've been present at, I haven't seen anything like this before. But we have to think about the time of year lists being put together, but I don't think that's any excuse to allow an ECB president to speak to an empty room. But I haven't put my favourite question yet. The risk assessment of sovereign debt. I know the risks. If they are attributed a certain level of risk, I know that the bank system could be stressed. Looking forward, we could see interest rates rise, of course, and the bank sector could benefit from that, of course. But on the other side, for at least 10 years, we've been having a discussion in the Basel Committee about the separation of bank and state. And you've taken some measures in the south of Europe. The share of sovereign debt has increased. Now, can you see, in light of all of the advantages and disadvantages, a way out of the situation where sovereign debt is not being attributed the risk it actually has? Thank you.
Sorry. What is the last question you asked about?
Gibt es ein...
Is there a proposal, is there a way out from this situation that we have, where the difficulty of non-risk assessment and the ramifications of actually carrying out that risk assessment? Do you see some kind of instrument in the long term? What could a solution look like?
Thank you. Yeah, you're right. There was a very protracted discussion in the Basel Committee on this. And in the end, the Basel Committee decided to do nothing about that, because the sovereign debt is treated differently in different parts of the world. The rest of the world, sovereign debt is risk-free, or at least is considered to be risk-free, and therefore banks are not asked to have risk weights on that. Of course, the reason behind this is the fact that the central bank is always there to print money to support the government debt when time comes. That's the implicit assumption. Now, whether this is true, happens or not, is a different question, but the implicit assumption is there. In our case, in the case of the Eurozone, we've discovered that sovereign debt is not risk-free. And so, to this extent, the case for considering it in the bank's portfolios as something that's risky is there. The issue is, how do we deal with this And the view of the ECB is that we should, it's not simple, the answer, because clearly the view is to deal with this with price measures, price-related measures, risk weights basically, but not quantitative ceilings. At the same time, and this was the issue in the Basel Committee, there is an issue of level playing field. If we ask the banks of the euro area or the European Union to have risk weights, we make investments in a certain asset more expensive, more costly than it is for the banks that are in other parts of the world. So we have this level playing field issue. More generally, I believe that actions along this line should be, first of all, quite sensitive to the financial stability, possible financial stability implications that this action might have in different parts of the Eurozone, different member countries. And, but also, they should be part of an overall package where if one loses flexibility that the banking system may provide in supporting debt and deficits, one wants also to have more progress on other fronts of the overall package, of the strengthening of the economic and monetary union. I think all these situations make the discussion objectively difficult. And by the way, there is also another side to this. When a country goes belly up, as they say, it doesn't really matter whether a bank owns a lot of sovereign debt or not. All banks go badly, whether they have a big portfolio of sovereign bonds or not. So there are all these considerations that make a discussion due. We have to cope with this because sovereign bonds are not risk-free. And at the same time, it's complex. So but the thing not to do is to ignore reality. Thank you.
Thank you. It's indeed complex and also taking into account that regulation asks banks to have a highly liquid risk-free asset in the balance sheet. So if we don't provide an alternative highly liquid risk-free asset, then to be the only jurisdiction in the world that do not have such a highly risk-free asset, it's really it's difficult to deny that this becomes a problem. So it's a bit one of the two in this sense, and the problem is the same that do support the introduction of this risk weight are against the creation of highly risk-free common risk-free assets. So, and then we had bit in a vicious circle. So that's, but that's a matter, an issue for indeed a broader package. I fully agree with that. Pervenche Beres.
Merci. Ça sera la 5e fois.
Well, thank you very much. It'll be my 5th time, but the last time today that I'll be asking you questions. President, now, in a way, you've looked at the supervision of macro risks. That's in line with the mandate you've received from the legislator. And today we've been talking a little bit about the link between your two different roles. As co-rapporteur on the review of ESRB governance, I wanted to check with you what is your own assessment of the current governance model. Sometimes you use scientific committees and other inputs to your governance, but you also have the link to the central bank and the ESRB and how they fit together. When we set up the macroeconomic supervision structure, you'll remember that was at the depths of the crisis. We were doing the kind of things you picked out for the insurance sector. That was really lacking at the time for the banking sector. It was important that we could put together a roadmap for them, but we did that without really having an overview of the risks that were out there. So how does this work in your governance? And given your impact on monetary policy, it's important that you should have a good overview of the macroeconomic risks out there.
Yes, I completely agree with you. Let me go step by step here. First of all, just looking at the amount of work and the scope of the SRB work in the past few years, even what transpires from today's conversation, really, one is bound to say the SRB has worked well. And of course, I'm a biased observer in this, but I think it would be pretty shared that it was pretty effective in identifying risks, in identifying vulnerabilities, in recommending action through warnings, recommendations. So by and large, in complying with the mandate that it was given several years ago. The issue then was raised a couple of years ago, I think, about a potential conflict of interest of the ESRB having the same chair of the ECB. I frankly cannot find one instance of this conflict of interest, but I've also asked around, and nobody's able to tell me where this conflict of interest is. And the reason is in a sense, is a logical one. Macroprudential policies complement monetary policy. They are never against monetary policy. More specifically, how would one answer to the point often made that low interest rates are the seeds of financial instability, that prolonged periods of large liquidity could simply be the beginning of a next financial crisis? Our answer, the ECB answer, has always been, I don't think that changing monetary policy because of this would make sense, because it would simply jeopardize the recovery and, if anything, increase the financial stability risks of the area. The answer lies in adopting the proper macroprudential policies that would address these risks. That's an example of how macro and monetary policy do complement each other. So there is no conflict of interest here. If anything, there are the synergies that you hinted at in your question. So, concluding, I don't think it's up to me to discuss governance because I'm clearly the object of this. If I have to give an opinion about that, it seems to me that the governance of the ESRB has worked. We frankly, the ones who work in the ESRB, the members of the board, don't find a case for changing the governance. Of course, if there is something to improve in terms of accountability, transparency, reporting, we stand ready to carry out all the improvements that are needed. The thing, in my view, the route not to follow would be to create a plurality of voices of the ESRB in reporting outside and, for example, to this committee, because that would naturally create divergences of views, and all in all, this would create reputational damage to both institutions.
Let me just add that I fully share the opinion by Werner Lange that it's a pure scandal that we are not more numerous today for this monetary dialogue. I think we were together when this monetary dialogue was settled. This is the first time I see such a situation. I know colleagues are campaigning for their position on the list, but this is not enough.
Thank you.
Yes. I fully subscribe, and I would like to make a final question because we have been identifying sources of risk during this exchange of views very appropriately. We have discussed about insurance, we have discussed about sovereign, we have discussed about MPLs. So my question is, taking into account that we are seeing from the other side of the Atlantic, also on the basis of some court rulings, and that leverage lending and also new products that we know have been also partly responsible for the financial crisis are being used again. So what is our assessment? Are we on the other side of the Atlantic with the rules we have done safe? Do we have to look more carefully to level 2 or level 3 assets in the balance sheet of our banks? Do we have problem with the non-banking sector and its connection with the banking sector? So is what we are doing and what you are doing, SRB, enough of there is other area of risk that we should monitor more carefully in these 10 years after Lehman Brothers?
Thank you, Mr. Chairman. The last few years have seen a step in the other direction in terms of regulation in other jurisdictions. In other words, there has been a movement towards some deregulation in some jurisdictions, whether this was produced by legislation or was produced by changes in regulation or changes in supervision by the supervisors, or, as one case that you hinted at, by court rulings. And I'm referring to one court ruling which regards risk retention in securitized products. So this is the fact. And we've seen that of recent products that were not really mentioned very often after the great financial crisis, like CLOs and CDS and CDOs, actually, have been now named more frequently again. Now, the danger we have on this side in our own jurisdiction, the danger is that in this search for yield, we repeat the behaviors that characterized the financial crisis, namely many entities, banks and non-banks, searching for yield, both into what we used to call toxic products, toxic assets, that later actually were the primary engine of the crisis we had in Europe. And this is the danger. Now, in this specific case and this specific time, much of this exposure in this new sort of new products is actually carried out by non-banks. And again, so we have another reason to increase our visibility on the non-banking sector, to expand the toolkit of our macroprudential instruments to the non-banking sector, but also to monitor our bank's exposures to these assets now. Check whether this has really becoming, or risk becoming, I don't think it is yet, a risk becoming an increase in exposure which could be worrisome at some point in time. Thank you.
Thank you very much. And I think this has been one of the most interesting ESRB exchange of view we have had so far. So it's really a pity that many members consider more important other activity, even if we all are elected politicians, so we understand how sometimes important to be at home in crucial moments. But I think many of the issues we are discussing are really, really very important, and I hope that also we will have the time and our legacy for the next Parliament to discuss about these things, contribute to avoid the risk that after a lot of efforts we have been doing since the financial crisis in building up, let's say, more resilient regulatory framework, we have loopholes, and then all the important work we have been doing then risk being, let's say, undermined by those loopholes. So that's extremely important. So thank you very much for your very important thanks for this very interesting dialogue on ESRB, of course, and also on the previous one as a ECB chair. So we can now conclude, make a short suspension, and we will be back at 6 p.m. with the VAT and with a joint meeting with the budget. Thank you.
Thank you. Thank you.